Good afternoon, everyone. I'm joined by Lawrence Lancaster, our group of tax. Lawrence and I are going to be discussing, particularly where it relates to British expats in the UAE, the question of residency, domicility, both for individuals, also for companies, and some of the potential changes that we think are coming up. Obviously, we've got the UK elections this week, and we anticipate there may be some changes there. But what UK expats particularly should do and should be looking to do if they've been here for a long period of time and are looking to stay here for the future.
Sure.
So thanks for joining us, Lawrence. We're obviously very well positioned in the UAE. We have a lot of British expats moving to the region for business, for residency. What should they be considering, over the period of time that they're starting to bring family here and starting to move here?
General considerations. Yes, I think first of all, you have to check. The expat is obviously a very broad term. The focus of this discussion, I think, is a UK expat. What do we mean by the UK expat? Well, traditionally, that person would be someone who had a UK domicile of origin. So somebody who is from the UK, whose father, their family were from the UK, they were born in the UK, educated in the UK. Typically, they start their careers off in the UK and then things change. They get a transfer, often to Hong Kong, Singapore, UAE, and often it starts off for being a temporary purpose, but then they actually lay down roots in the place, and more often than not, it's a gradual process that they establish their home there. That's what I would regard anyway as an expat, somebody who's a long-term non-resident from the UK, a UK expat, somebody in contrast who is away for a couple of years on secondment or a short-term assignment and then goes back to the UK. You would probably say that that isn't an expat. That's just someone who is away from the UK for a temporary purpose or a temporary basis. But for those persons who fall within this definition of expat, what should they be considering? As I said, traditionally it was domicile. So have they actually managed to acquire a domicile of choice in the country to which they've moved? If they have, if they were lucky enough to achieve that, then it means that their worldwide assets are no longer exposed to UK inheritance tax. This is the big distinction between an expat who is acquired a domicile of choice in the country where they're living compared to an expat who has not. And I think we're going to come on to discuss this point about how you acquire a domicile in a minute. Now, this was traditionally the position, but we are now looking at a big sea change in UK taxation, in that domicile is going to be replaced by residency-based test, it seems, from the 6th of April 2025. So we're going to come on to that as well. But I think aside from domicile, traditionally, what else would you look for? Or how many years have you been non-resident for? The UK, under first principles, if you were non-UK resident for the whole of a tax year, then the income and capital gains that arose in that tax year should not be taxed in the UK when you resume UK residence. So that used to traditionally in the 80s that you would see, I think, that people would go away for one tax year, would sell assets in that tax year, crystallize capital gains, and come back to the UK without paying tax on that. Now that changed for capital gains tax purposes in, I think it was 1999, where Gordon Brown introduced anti-avoidance legislation that required 5 years of non-residence. And that meant that if you were non-UK resident for, say, 3-4 tax years, and you sold an asset within that period, there was no capital gains tax in the UK when you sold the asset, but then you returned within 5 tax years, you would be taxed subject to capital gains tax when you returned to the UK. So they would claw back the tax. Now those rules were extended to certain types of income in 2013. And the test was tweaked slightly. So you now have to actually be non-resident for more than 5 tax years, not just 5 tax years, as was the pre-2013 position. And that's a real trap that people often miss, which is, I've done 5 years, I've sold a load of assets, a load of income I've received, often dividend income, I can now go back and I won't be taxed because I've done my 5 years. Well, that's not right. It has to be more than 5 tax years. So typically now you want to be planning for 6 complete consecutive tax years, or if you want to be a bit more risky, 5 years plus a split year. But split years, you would always, it's recommended to do 6 or more tax years. So that's the other thing is, was it caught by these temporary non-resident rules? And I think the big one that we often come across in practice there is dividend income. If you had shares in a company that you owned, usually a UK company, before you became non-resident, it's really common scenario. Clients have UK companies, they take a small salary, what they need to live on, and then they've got this retained earnings built up within the UK company. And they think, well, I'll become non-resident. Oh, I only need to be non-resident for 1 tax year, and then I can come back and I won't be taxed. Well, that's not right. Since 2013, these temporary non-resident rules apply to that type of case. So if you've got these shares in companies, become non-resident, you've got to plan for the 6 tax years of non-residence. Where the 1-year rule still applies is to, and all of this stuff I think is really relevant to expats, is for employment income bonuses, any form of remuneration that isn't subject to the temporary non-resident rules. So that means that you can go away, receive an income from employment, bonus from employment, even still 1 year of non-residence, that won't be taxed when you become UK resident again. So that's the big one, where you're still subject to the classic 1-year rule, not this 5/6 year rule. So yeah, the residence, domicile, temporary non-resident rules, source of income, capital gains, I think all of those things an expat should consider. And of course, what UK assets they still hold. A big one that we see, which is a really common scenario, is UK property, where an individual held UK property before the 6th of April 2013, which is when they introduced capital gains tax. You can have cases where the individual owned property, say in the 90s or the 80s, sitting on a really, really large capital gain if they were to sell it as a UK resident. What people don't often realise is once you become non-resident and you sell it, you get the uplift in base costs to the value on the 6th of April 2013. So it's almost like a magic wand is applied. And even though you were UK resident when you bought the property and UK resident in 2013 when they introduced capital gains tax for non-residents, as long as you're non-resident when you come to sell it, then you're deemed to have acquired it for its market value on the 6th of April 2013 for residential property, and for commercial property, for other types of property, April 2019. And that can be really valuable for clients who have owned these properties for a long period of time, for expats. And you often find an expat has owned property for a long period. Now, as well as that, you often find that they use their property as their main residence. And that is another big one to consider, because you still do get relief for that, but only for when you used it as your main residence. So it can get quite complicated, the interaction between the 2013 rebasing rule and main residence relief. But what I would say to all of this with capital gains tax planning, it does require you to be non-resident for the 6 tax years, 5 to 6 tax years. So if you are relying on that rebasing rule for your planning, you've got to make sure you do the more than 5 tax years. So yeah, I think that they're really the common kind of areas that we experience when advising expats.
Interesting, Lawrence, thanks. What about those expats like myself that are not planning on going back to the UK?
Mm-hmm.
I speak to a lot of people and they still are not really aware of this distinction between residency and domicility. A lot of people think they automatically bring their domicility with them, but that's not the case, is it?
And it's kind of not helped by the fact that in civil law jurisdictions, they have a completely different concept of domicile, which is more akin to residence. And then you also see it being used for habitual residence, where you've been resident for 3 years, and then you regard it as domicile. So it is a term that has different meanings in different jurisdictions, particularly common law, civil law. But under the traditional common law test, the 3 types of domicile of origin, choice, and dependency. And your domicile of origin is typically taken from your father's domicile when you were born. So if they were UK domiciled at your birth, that is your domicile of origin. How do you get rid of that domicile of origin? Well, by acquiring a domicile of choice. You can only acquire a domicile of choice after you reach 16. If your father's domicile changed between your birth and your age of 16, your domicile will change with your father. So, for example, if you were born in the UK, father UK domicile, but then the family moved to South Africa, and father intended to remain in South Africa permanently, you would then acquire a South African domicile of dependency, which would become a domicile of choice when you were 16, but it wouldn't affect your domicile of origin, which would still be the UK. But in any event, if assuming that father remains UK domiciled, so no domicile of dependency, you've retained your domicile of origin at the age of 16, how do you get rid of it? Well, it's through the acquisition of a domicile of choice, which combination of two conditions: residence in a place and intention to remain there permanently or indefinitely. And it's that second limb which is always the problem. Particularly clients, Jim, in the UAE. I think I said, or have said in the past, probably about 90% of expats here, that's to sort of pluck a figure from the air, but I would say in experience, the cases that I've dealt with in the UAE over the years have been 1 in 10 really, where you'd find an expat, UK expat with a UK dom of origin has acquired a domicile of choice in the UAE. It's really tricky because most of those expats do not intend to remain here permanently. But in your example, you've given yourself as an example, you do intend to remain here permanently, and you've established sufficient ties with the UAE to corroborate that intention. It's all very well saying what you intend, but you have to have enough ties to be able to back up that intention. So, for example, if you just come here from the UK, you don't own any property, family are still resident in the UK in the family home, you rent out a place here, you've been here for a couple of years, you're working, and you say, well, I intend to remain here permanently. That's not going to wash. So you might state that, but you haven't established sufficient ties to be able to justify that stated intention. But contrast a case to yours. If you've been here for, say, 10 years, family are here, you own a property here, long established career here, assets here, the right to remain here, although that may be qualified, but as long as the right for you to remain permanently, it might need to have to be renewed every 5 years, which I think is the position. But as long as you realistically can remain here permanently, and it's not going to expire after a period, and then you'll be effectively not allowed to remain. As long as there's a realistic chance that you can remain, you've got every chance to, then then that won't be a problem. The fact that you don't have a passport here and an absolute right to remain permanently, which no one has. So it's really that distinction between those expats who have the ties and have the length of residence compared to those that don't. I think one final point on this with domicile is that even once you've acquired a domicile of choice, you remain deemed domiciled for inheritance tax purposes for 3 years from the date of acquisition. So let's just say you came to the UAE in 2005. Gradually, as I mentioned earlier, it's very rare for clients to intend to remain here straight away, although some do. But most of the time it happens organically, and your career prospers, you buy a property, you get PR, permanent residence, and family becomes settled here. So, and it's normally a kind of combination of those factors or a real trigger event. Sometimes it's when you buy a property, sometimes it's when you acquire PR, or as I say, a combination of these things. You say, right, I intend to remain here permanently, and that intention is then corroborated by these other factors. So in those type of cases, you really can justify this assertion. So let's just say you intended to remain in the UAE permanently July 2010 because enough of those factors were present to justify the claim. And obviously this has to be a genuine claim. It's not the case that you kind of tick boxes to then and say, oh, this is what I intend, which you don't actually intend. It has to be a genuine intention. But the point is, the intention will only be accepted by HMRC and the courts if it's supported by sufficient external factors, objective factors. But let's say you acquire the domicile of choice on August 2010. You would remain deemed domiciled for IHT purposes until August 2013, after which you would be completely free of UK tax, free of UK tax, UK inheritance tax on your worldwide assets.
Got you. And that's the key there, isn't it?
Yeah.
So if you think and it's the intention, and obviously the option is really to then crystallize that intention, potentially with a barrister opinion, or speak to our team and we can kind of guide you to see whether you do fit that criteria.
Yeah, that's right. So the testing process is we would send out our generic questionnaire on this for those cases where we think that there's potential for to get this positive counsel opinion. And then there's a process involved in this. The fact find information gathering exercise is very important to make sure we have all the facts clear on all the circumstances, and go through the life history of the individual. Make sure that they don't have any UK property available. I mean, having UK property is not fatal to a claim to be non-dom, to intend to remain somewhere the other place permanently. But the problem is that if you have a case and you haven't gone through the fact find, let's say you take on a client, they say, well, I intend to remain in the UAE permanently. They say, oh, I've got this tie, this tie, this tie. But they don't reveal the ties they still have with the UK, and they've omitted to tell you that they still own a UK property that they use. That opinion won't be worth the paper it's written on, because it hasn't dealt with all the relevant facts. So it's really, really important to do the fact find and make sure that everything's covered. And what you want is for the individual to write a statement, which we assist with, which goes through their whole life story, chronology of key events, until you end up to the present day, where they say that they intend to remain in this place permanently, and everything is documented. What we also do is to provide them with a list of the information and documentation HMRC would want to see. So they then go through and keep copies of birth certificates, visas, passports, title deeds to property, and all these things that HMRC would want to see if they initiated an inquiry into that individual's domicile. We would also then write our own opinion on it, and then we would go to counsel for a second opinion. So at the end of it, what the individual should have is a statement, our opinion, the counsel opinion, which is the binding one, and then a pile of documents which they keep in their own file. There are also cases, not really with expats, which we're talking about today, cases where clients had a foreign domicile of origin but potentially acquired a UK domicile of choice. It's the other way around. In those cases, we want to have statements from the parent, because it's the parent's intention which is then really key to be able to show that the parent was non-domiciled when the client was born, because that's what gives them the foreign domicile of origin. And in some cases, the parents are dead, so that's not possible. But it's really kind of like gold dust in those cases where the parent is still alive to get that statement from them. So it really is important to get all of the information together, all of the evidence together, all of the statements together, and really create a domicile Bible that you have. And then it comes on to what planning you want to do once you've got that in place. And typically the classic planning has been excluded property trust, which is, definition of which is, settler is non-dom, assets going in are overseas assets. If those two conditions are met, then that's EPT. And the really good thing about that, at least as the law is at the moment, is that the domicile of the settler is tested when the trust is established. So you don't have to wait until death and all the uncertainty that gives rise to. You test your domicile, as I've just described, and then you place your assets into trust shortly after doing all of that work. And that puts you in the strongest position that you were non-dom when the assets went in. And that's it. It's tested at that stage. And even if your domicile subsequently changes, the excluded property trust remains intact, and it will always be outside of Inheritance Act. The one exception to that is if, in the expat context, is if you've got an expat from the UK, acquires a domicile of choice, say in the UAE, sets up an EPT, they go back to the UK for a couple of years, say the parent is ill or child at university or finishing off their education, all very common scenarios. They'll be deemed UK domiciled again for income and capital gains tax purposes from the first tax year and for IHT from the second tax year. So that principle, and that includes the trust that they settled the EPT, so that loses its protection. And that anti-avoidance law was introduced in 2017, and it goes against the principle that the EPT is always outside of inheritance tax if the settler was non-dom when it was made and it only holds overseas assets. But that's the one exception at the moment, and the principle is as long as you don't go back to the UK as a resident, a tax resident, your EPT will remain permanently outside of UK IHT, even if you lose your domicile of choice. So let's say you leave the UAE, your intentions change and you move to Thailand. Well, in that type of case, your domicile of origin would revive. So all of your UK domicile would revive. All of your worldwide assets would then be back within the IHT net, but assets wrapped in that EPT would not be. Right. Which is why they have all these traditional key advantages for expats.
So a lot to think about there, and obviously you can keep an eye on it as you progress, depending on the choices further down the line.
Yeah,
we've spoken to quite a few business owners, UK-based business owners, and they're also talking about potentially, particularly where they're undertaking service, service type delivery within the UK, potentially moving or setting up a branch here.
Yeah.
But also the possibility of moving the residence of the company. I don't know how this is. Obviously the location, physical location, where it's managed. There's a substance test there.
Yeah.
And that's something a little bit away from the domicility of individuals.
It is.
Do you look at that as well?
Yeah, I mean, we look at that as well. So this is obviously, we're moving now from individual tax flipping over to corporate tax.
Right.
So yes, the basic point is that you have a UK company, and the UK company is looking to expand its business into the UAE. It could look to do that by setting up a subsidiary here, wholly owned subsidiary, or it could look to set up a branch here. I think the fundamental problem to start with a branch is that would still be subject to UK corporation tax, because it would still be an asset of the UK company. Right. Obviously, it would get credit for the tax that would possibly now be paid here, depending on against UK corporation tax. But if it's a branch, then it still forms part of the assets of the UK company, and it doesn't have separate legal personality like a subsidiary. So the income and gains that are generated from the branch would form part of the income and gains of the UK company, the UK corporation tax, albeit you get a credit for any tax that you incur here.
But that wouldn't be the case for a separate LLC, for example.
It wouldn't, no. Right. So if you're setting up, you have to be careful that it is a company and it's not a partnership. Get into issues there with LLC is always a bit of a concern, because I know with Delaware companies, they can be treated as partnerships for UK purposes. I'm assuming that the LLC is treated as a company for our purposes of our law.
Yeah.
Hopefully it is. I mean, normally the test is whether the overseas entity is tax transparent or not. So as long as the income and gains is treated as the income and gains of the company and it's not attributed to the shareholders, as it can be in Delaware, then for UK purposes, it will be treated as a company. And that's what we want, because that ring fences the income and gains within that company wrapper, or it should do. So if to give you an example, if you've got a UK trading business, has profit that's been UK corporation tax has been paid from, it wants to invest overseas, it identifies the UAE as a target market, and then for commercial reasons, it sets up an LLC onshore. Then the income and gains that accrue to that company should not be taxed on the UK company. Now, there has just been some anti-avoidance legislation, which I'm not going to go into in this chat, introduced in the Finance Act of 2024, which potentially could impact on this. But I still think in this example, where it's all done for commercial business reasons, you should still be okay, notwithstanding that new legislation. But leaving that aside, the basic point is you've got your overseas wholly owned subsidiary. The profit is taxed here, if at all, not taxed in the UK. When dividends are paid from here to the UK company, they should be exempt from UK corporation tax under the distribution exemption. There's a very useful tax treaty which the UAE and the UK concluded a few years ago, maybe 10 years ago now, around there. And that ensures that the distribution exemption applies. And with trading businesses, if the UAE company is trading, you've got UK holding company, you should be able to still dispose of those shares. The UK company should be able to, particularly if it's got other subsidiaries, dispose of the shares in the UAE company without it attracting corporation tax on the gain. And I think also you'd be able to liquidate the UAE company without having corporation tax on the proceeds of liquidation as well. So yes, I mean, very useful structure to have that UK company with a subsidiary in the UAE. You mentioned earlier about changing residency. We need to be careful there. What you can't do in the UK, and a track would be to, if you had to stick with this example, a UK trading code,
Yep.
and you appointed sovereign, let's say you've got Mr. Bloggs in the UK as director, rather than doing the subsidiary planning that I've just described, he instead appoints sovereign as third-party directors and says, well, hang on, there's a treaty here between the UAE and the UK. The treaty says if it's managed and controlled from the UAE, then that means that it's taxed only here, not in the UK. Yeah. So that means no longer there's going to be corporation tax in the UK. Well, the problem with that, and I haven't looked at, by the way, at the treaty, most treaties do say that, but the problem with that is that the UK has this exit charge that it applies. So there's a deemed disposal of all assets. So any assets that are pregnant with gains, you would crystallize those gains when you appointed sovereign as the director. And they would then be taxed now at 25% generally, which is the rate of corporation tax in the UK. So not sensible planning. And that applies the exit tax charge, even if the shareholder of the UK co has become non-resident. That's the problem with UK companies. You're locking them into the UK regime, even if the UBO moves. The residents, the UK company is a separate legal person. It's taxed in its own right. If the shareholder moves away, company's locked in. And that's a big difference between companies and companies and individuals for UK tax purposes. If a company changes its residency by appointing foreign directors, there's an exit charge, as I've described. But if an individual can still move from the UK without incurring an exit charge, and then is free, subject to those temporary non-resident rules, on its overseas income and gains won't then be taxed in the UK, and they're not going to be taxed when they go. But that could be something Labour, if they do form the next government this week, as we all expect, but that could be something that they look to introduce. So again, as we keep on advising people at the moment, if there's planning available, don't wait around, utilize it now. Things, as from a tax planning perspective, are probably going to get harder, not easier, in the coming years.
Thanks, Lawrence. On that last point, obviously you're getting a crystal ball out there a little bit. On the individual, they've already talked about, there's already been some changes to the non-dom within people who are living in the UK.
Yeah.
What changes do you think they're going to be made? Assume the Labour government, make a number of assumptions here, and possibly get your crystal ball out. But give us a last kind of final thought.
Yeah, well, I think what happened with this was Labour was always clear the last few years, since Jeremy Corbyn actually was their leader, and I think even before that, Ed Miliband, they were saying that they were going to abolish the remittance basis of taxation if they formed the next government. Well, none of us expected Jeremy Corbyn to form the next government, so we were all like, well, we're safe, the remittance basis is here to stay, no worries about that. Or you non-doms, we just have to look at what the Conservatives are saying, and they did attack it a bit in 2017, but overall those changes, as long as you're not an expat who goes back, for foreign non-doms who go, that was all generally fine, complicated system, but fine, for planning. But then what happened was Labour new leader in Keir Starmer. This was one of the few clear policies that they had, that the remittance basis is going. Just to be clear, the remittance basis is the system under which non-doms who claim it are not taxed on foreign income and gains unless they're brought into the UK. Right. So it's an exemption on foreign income and gains, unremitted foreign income gains. So that quite complicated. That was a basic system. So Labour said, well, we're going to scrap that and replace it with a system where you only get an exemption for a few years, regardless of domicile. Conservatives poached that policy in the budget of this year, 2024. There was a few rumours a couple of weeks before it, that's what they were going to do, and it did come to pass. We had a technical note that was published on budget day, and that's all we've got at the moment, and some musings from Labour. But basically what they're saying is that remittance basis is going, domicile is going for tax, absolutely sweeping change, fundamental change to our tax system, will be replaced by a residence-based test, which for the purposes of income and gains will mean that if you've been non-resident for 10 consecutive tax years on the 6th of April 2025, your income and gains, which are foreign, will not be taxed for the first 4 years of residency broadly, and you can bring them into the UK without being taxed on them. So you've got to have this 10 years of non-residence, and if you have that come 2025, then you should qualify even if you're UK domiciled, it seems. So domiciles go. The other sweeping change was that for inheritance tax, they're saying that it's going to be replaced, domiciles going as well, out the window. We're instead going to have a residence-based system under which if you're resident for 10 tax years, you'll be subject to IHT on your worldwide assets. If you're non-resident for 10 or more tax years, you won't be, regardless of domicile. So that's what domiciles going, residents coming in. Now, Labour have indicated that they will accept most of this with a few tweaks. There's some transitional measures that they're not going to honour, it seems, but we'll see. The one big difference between Labour and the Conservatives is the Conservatives were crystal clear that trusts which were established before the 6th of April 2025 would remain outside of inheritance tax if they were outside of inheritance tax before that date, so if they were EPTs. Labour have said that's not the case. So if the settler of the trust becomes resident for 10 or more years, the trust will be subject to inheritance tax as well. So that means 10-year charge on the trustee, inheritance tax on the settler if they're not excluded as a beneficiary. So what we'll have to see is that settlers who are UK resident and approaching the 10-year mark, once we see where Labour lands on all this, we may have to look at excluding them as beneficiaries to ensure that the trust remains at least outside of inheritance tax. Not the 10-year charge, you'll still get the 10-year charge once the residence test has been met, so once you've been resident for 10 years, but you shouldn't get inheritance tax. And it's for this reason that we are encouraging trust planning now, generally speaking, and subject to all of these caveats, on the basis that it's likely to give you more options once the legislation is published. If you wait until publication, the chances are it's going to have anti-forestalling measures, which is going to make planning more difficult than at the moment, where there's no draft legislation in place. We're just basing it on the technical note, and more importantly, the existing tax law which is in place at the moment. And it's quite interesting as a kind of a final thought about what Labour is saying with excluded property trust planning, the fact that they're saying it's a loophole that that you can remain outside of inheritance tax even if you live in the UK for a long time. Well, it's quite interesting, the origins of excluded property trusts. They were actually introduced, I was looking at this, by Finance Act 1975 by the Labour government. Right. So they actually created these things that they're now claiming are loopholes, and it just reflects how long they've been in place for, almost 50 years. We've had these things in place for. So they're very much the fundamental core of inheritance tax planning rather than any form of loophole. And I think that's why we're saying to clients, well, look, you can set these up now, rely on legislation now that's very, very well established, and then look to do tweaking to that. Worst case scenario is you have to unwind the thing. But you will just need to be very careful with this planning when you get the advice that it comes with an exit strategy as well. Because the last thing you'd want is to do this, and then looks like you have to unwind it, and then you get a tax charge when you come to unwind it. So the planning and the advice has to account for an exit strategy as well. But generally speaking, it's better probably to do that than to wait and see, just because you can do that planning now. You don't know what is going to be available to you when this new legislation comes in.
And when it comes in, we think emergency budget likely earliest October, and then from that point on.
It could even be sooner than that. But I mean, what we were expecting a few weeks ago was that the election would be in the late autumn. But they brought it forward to the summer, which is a July, very unusual time to be having a budget, but you don't know. Still, the expectation would be that it would be kind of September, and then a draft finance bill to be published shortly after the budget. But we'll see whether they have something sooner. Again, it really just means for all of these people who could be affected by these changes, probably best to do your planning sooner rather than later than to wait and see, because the way it's going is that things are going to become more difficult rather than easier. The one exception, of course, is for the expats who have been non-resident for more than 10 years and who are currently still UK domiciled, and there's a large chunk of these people, 90% of expats, I would say, in the UAE, to pluck that figure from there. So there's this expectation that, we're going to be outside of IHT on our worldwide assets because we've been non-resident for more than 10 years come 6th of April 2025. Well, that may be the case, but it might not be either.
Right.
And it seems like too good to be true that Labour is going to move from a regime where these people are subject to 40% tax on their worldwide assets when they die to a regime when they're not.
Yeah.
Does seem. And we'll see. Our concern is what Labour could do is move to a regime where you've got one rule based on 10 years of residence, and then you've got to be, if you do the 10 years, you've then got to do 10 years of non-residence to get out of it. And alongside that, you could be automatically subject to UK inheritance tax on everything if you're a UK citizen, hold a UK passport. And that's the real danger. And there are hints in the note that was published by the Conservatives on Budget Day that they were exploring other connecting factors, and the only other connecting factor would be nationality. Right. You've got domicile, residence, habitual residence, and then nationality. They're really the only three ones that we know. So the fact that they're exploring the option of another one would suggest that nationality could come into play. And as I say, it would be surprising if Labour were to take a load of people out of inheritance tax. So for those expats who do have a legitimate case to be domiciled in their country of residence, so the long-term ones that we were discussing in the discussion earlier, they have a choice. Do they get their domicile tested now and then do planning now, or do they wait and see for the new 10-year rule to come in that they will be outside of IHT regardless of their domicile? I think the prudent approach, again, is to probably do the planning now, because you know what the law is now. You don't know if nationality could come in as a factor and to determine inheritance tax. As I say, it would be very harsh. It's not something personally I expect, but you just don't know.
I think that's clear. Okay. Lawrence, thanks very much for joining us.
Hey, thanks, Jim.
Thank you. We'll see what happens.
Yeah.
Thanks a lot.
Thank you.